very good morning, ladies and gentlemen, to this year's results announcement. Unfortunately, because of the COVID, we're not able to have this face-to-face, but I'm sure that we'll be able to get the message across and share with you why we are really so proud and excited about this group and the stuff that we're doing in the group. Special welcome to our regulators, the Governor of the Bank of Namibia, the CEO of NAMFISA, also our shareholders from South Africa and other key shareholders in Namibia. We're really pleased to have you here. Our analysts, thank you for helping us think about our business. Thank you again for some of the questions that you're asking us today. And then of course the board for the strategic direction and guidance that they provide, also very welcome to you. The other members of the staff that are here, executive committees, and then also to the members of the media. Important that you are also able to take this great story in very difficult times to the market and share that there is really hope for Namibia. I was thinking to maybe share a little bit of my 5-year journey with you, since you know that this is coming to an end at the end of September. And when Conrad will then be taking over for the group. So just maybe a couple of highlights as to what has happened. And you will realize as I talk through this thing that it was quite a change of scenery over the last 38 years that I've been part of this group. When I came back from Zambia in 2015, myself and the rest of the EXCO team did a breakaway, and we then planned our journey for the next 5 years. And I'm sure by now most of you still remember our vision to be a great Namibian business creating a better world. And in the mission statement we were talking about be the preferred employer. We were talking about becoming completely efficient, and we said at the time it's not a spelling mistake the way that we do it. We do want to drive this whole electronic journey that we've got on. And out of all of this we then developed our strategy P to the power of 4, which spoke to our people, our partnership, our planet strategies, and how all of that would contribute then to the profitability of the group on a sustainable manner throughout the next 5 years. So the purpose of this discussion then is to just reflect a little bit on what happened over the last 5 years and were we able to achieve all the good stuff that we were talking about. So if you can just really at a very high level touch on some of the highlights. I think when we first talked to our partnership journey, is a number of very good and important strategic partnerships were created over the last 5 years, which helped us to become the leading institution in Namibia. Partnerships not just in Namibia, but also partnerships outside of Namibia, in South Africa, where we have done a lot of our product development, system development, and all of those good things. When you talk about our people, we've developed a very strong staff value proposition over the last 5 years, and our dream has always been to become the best company to work for in Namibia. And I think we have substantially also achieved that when at the last Deloitte, which is a completely independent survey, during that survey we've been appointed as the second best employer in Namibia of all the large employers that took place. When we also consider then the group engagement surveys that we've done, year after year we could see how we were improving on the performance ratings through the ratings that you gave us, the staff, as well as the ratings that we got from Deloitte. Because it was important for us to be the best employer in Namibia and to continue to improve in the way that we've done things with you. We also invested heavily in caring and developing for our staff. The third piece that we've spoken about and that we've agreed on is our planet journey. And in planet we've said that we want to really contribute to the development and the protection of the society, the environment, and the economy in Namibia. And again, when we look back at that, we have through the FirstRand Foundation contributed more than 60 million Namibian dollars over the last 5 years towards well-being in Namibia, towards this specific cause. Including in that 60 million is the 10 million that we've just contributed in this year towards COVID specifically. But when we look at our FirstRand Foundation, and we talk about, on the one hand, we've got the development side of it, but we also talk about the protect side of our economy and the society and the environment. So under contribution, we were looking at things like protecting the environment that we're operating in, the culture contributions that we've made, arts and culture contributions that we've made. But then on the development side, there's a whole lot of education that we've plowed in, SME development that we've done, and a lot of other areas that we've invested quite heavily in under Planet and what we're doing. Now, this whole Planet strategy of us is now evolving further into the shared value concept. And we are talking about how can we create shared value in the country that we're operating in. And shared value, as we know, is a lot more than just corporate social responsibility. There's a lot more that we must and can do as an organization. And I'm really pleased to see how well the shared value concept have landed in the business plans of our different segment strategies, both corporate, commercial, and in retail. And we will see a lot more of this as we take the business forward. And I'm sure Conrad will also spend some time with you on that. The last one then is obviously all of this, what we have done, is how does that then reflect in our financial results? And really, again, I think if we look at how we have performed as an organization in Namibia, we measure ourselves against our peers. We continue to be the #1 financial services group in Namibia. During this 5 years, we've also incorporated Ashburton into the group as a result of the transaction with Point Break. And that business is starting to really gain some good traction in our business and contributing well to the bigger group. Similarly, RMB, that was established around about 5 years ago in Namibia, has really gained significant traction, becoming a major player in the bigger economy and a contributor to our business. So really proud financially as to what has happened and the value that we've created for shareholders in Namibia. But part of our conversation, our dream when we started was to become an efficient bank. And we've developed a very aggressive digitalization strategy on how do we want to change the world of banking in Namibia. And I've reflected a little bit on that. I've mentioned that when I started in the bank 38 years ago, there was something like 35 branches. And all the transactions that we've done at the time were done in those 35 branches. When I came back from Zambia, I think we had around 55 branches in Namibia. And then the whole transaction to ATM started taking place. And we introduced ADTs. And just on the ADTs, it's very pleasing to note that while we still performing something like 50,000 transactions, deposit-taking transactions in our branches, we are now doing 350,000 transactions, deposits on ADTs. Our number of representation points from the 35, 55 when I came back has now grown to more than 650 points in the economy where people can make deposits, can make withdrawals in all areas throughout Namibia. Whether it's in the Bundu, whether it's in Noord-Oever, whether it's in all those places where we never had infrastructure and branches for. People can now transact and make deposits. And in fact, through our Cash Plus arrangement with some of the smaller businesses in the remote areas, we will very soon be able to open bank accounts remotely through assistant and unassisted channels. So in terms of efficient banks, all of that came to fruition because of our ability to bring in talent into the organization. We were the first bank in Namibia to really bring data scientists, properly qualified, degreed people to help us to analyze and understand our data and use that optimally. To employ engineers in our group to drive the processes that we have and to digitize and to optimize all of those. We brought robotics into the organization. And those were all firsts for the industry in Namibia. And in many respects, we even lead the central bank and the regulators that we have. And we spend a lot of time on helping them and taking them on this journey of digitalization that we as a group on. But we also know that as an organization, we've spoken a lot about that previously, we're working with cash. We're working with the most wanted commodity on earth. That means that it's a very, very high-risk business. And you know the kind of risks that we're sitting with. So we had to spend a lot of time and energy on getting our risk strategies and risk structures and risk systems in place. And I really think we've done well. And compliments to the team in enterprise risk management, in financial crime, Johan du Plessis and his team, Sean van Rooij and his team, for all the good work that has been done over time to just aggressively manage this cybercrime and money laundering and fraud and forgeries and all of those things that are happening all over the place. But one of the big things that we were worried about was the process risk and the quality of internal audits that we had when I came back from Zambia. And really, I think we've been able to also turn that tide quite significantly. And I'm very proud and very grateful for the good progress and work that has been done over the last 5 years in our internal audits and the quality of audits that we are now seeing coming forward. So of course then the question comes up going forward, is it possible to still improve on this kind of set of results, the achievement, the journey that we had over the last 5 years? And absolutely yes. There's no doubt that there's still a lot of greenway ahead of us, there's still a lot of opportunity ahead of us, and that requires a little bit of different thinking, a different mindset for us at the leadership. And that's one of the main reasons why in October last year I've engaged with the board, suggesting to them that my 5 years, 6 years in Namibia should be coming to an end, because it's important for us to create new leadership with new vision, with new energy and thinking on how to take this business forward. So really I'm proud of the executive team that we've built and developed now under the leadership of Conrad, that will be taking charge of the whole group, Josephat that sits in Ashburton, Irvin that looks after FNB, being the retail and commercial segments, and then also Philip Chapman that is taking over the corporate segment and be running that. Together with the executive teams and the people with him, I really just see some positive upside for the group as we go forward. It's also very important that I've touched briefly on the promises, that we must stay true to our promises, because that forms the foundation of how we as an organization will go forward in the future. So really, let's live those promises that we've made. Let's make sure that people can see in the way that we operate, this is who we are and that we are truthful. And then finally, as we get all of these things in place and as we move forward, we will no doubt be able to create this future shared area of prosperity in Namibia. And all of us just have to and can contribute to that. So colleagues, from my end, Oscar is going to touch a little bit more on the finances. Conrad will share a little bit more on the future of the group. But really, thank you very much for the time that I was spending with you. It's a pity that I couldn't get out there and see all of you, but I'm sure that we will still meet. I'm still available. I'm not going away from Namibia. So still look forward to see you in the future, and good luck on this really, really exciting journey that you're on. Thank you very much.
Good morning. A lot has been said about the macro environment, and this is then our set of results given the macros that we experienced during the past 12 months. From a highlights perspective, our profit before tax at 1.2 billion, we managed to contain the decline to 23.7%. Headline earnings, a decline of 19% at 864 or 67 million. Our balance sheet advances were flat year on year, deposits a good growth of 7%. And then speaking of efficiency ratios, our cost to income ratio at 52.6%, a great number to reflect the current environment. And then our ROE down to 16%, and again that speaks to the decline in profits, and then the high capital base that we are carrying at this stage that gives us the 16%. Credit loss ratios at 179 points, again to be expected given the tough macros that we are in. And then from a dividends point of view, that's down 26% to 154 cents. If I can move on to our income statement, our top line, 2 billion in interest income, flat for the year. And then being a banking operation, our impairments of advances, a growth of 161%. And at this point, I would already like to highlight the split between the two provision numbers. As much as the total provision charge is 560 million, you'll see on the slide, stage 3 speaks to the non-performing loans, that's up 120%. And then stage 1 and stage 2, that speaks to our provision made on the performing book, and that's an increase of 190 million. That brings us to the 276 million charge. From a non-interest revenue, our NIR, that's up 3.7% at 1.8 billion. Insurance operation also up 3%, and that takes us to the PBT number of the 1.2 billion, down the 23% I mentioned earlier. And given that profits are down, our taxation number also down by 24.6%. From a headline earnings perspective, we'll get into the detail in the OPEX. That's an impairment of a goodwill, and that's the headline earnings adjustments that I'm referring to. And when I speak of normalized ratios, we are referring to the headline earnings adjustment, which is then year-on-year 867 million, down 19%. In terms of the number that everyone is waiting to see as to what was the impact of COVID on our operation, our earnings are down 467 or 464 million at least. In terms of the components of the 464 million, the rate cuts that came through sharply in the last quarter, I mean the 100 points in March and then in April also another 100 points. On our balance sheet, that meant we lost 97 million from an interest income perspective. And then from an impairments, given the lockdown of the economy, the job losses that got experienced in Namibia, our provision numbers are up by 252 million. And then our NIR was also not spared. The lockdown impact on volumes and the relief we provided to clients, that's also a loss of 108 million. Operating expenses, you can see there, that's an additional 7 million. And that's not taking into account any other expenses we would have incurred. That just speaks to our contribution to the COVID relief fund and then PPE expenses that we incurred. So from a direct impact of COVID, that's 464 million loss in earnings. And as you can see from the graph, where our revenue lines were in OPEX, and as you can see from an OPEX perspective, it's fixed in nature. That's the green line you see at the top, whereas our revenue, you can immediately see the decline once we enter the lockdown period in April. If I can quickly touch on our revenue line, our interest income is made up by three components. That's our interest income on advances. Our advances were flat year on year compared to credit extension, which was at 2.5% growth, and our interest income then at 3.3 billion, a slight decline of 2%. And given our investment securities that are up in the treasury space, our investment income there is up by 11%. And then another number that's pleasing to report is our interest expense, down year on year, which is quite favorable compared to the growth in deposits, which are up by 7%, and that gives us our 2 billion interest income that we saw. And as I mentioned in the previous slide, the impact of the rate cuts costing us 97 million in the last 5 months. In terms of impairments, let me spend a bit of time on this one. This is one of those numbers that, again, given the recession that we were already in, and then the extra pressure that the pandemic has brought onto us, as a banking industry, we are all feeling the strain, and it comes through this line in terms of impairments. Most economists are speaking that the current pressure that we are facing is worse than the 2008-2009 financial crisis. So in terms of non-performing loans, that's up to 4.4% compared to a year ago where we were at 2.7%. And in terms of the recent crisis that the banking sector has faced, in 2008 we were speaking of NPLs of 1% to 1.4%. So already there was a growth in terms of the recession we were already in that took us to the 2.7%, whereas now we're at the 4.4%, but still a good number compared to industry, where industry is already at 5.8%. So the quality of our book remains better than the rest of the market. So in terms of what the number itself is, our NPLs have grown to 1.4 billion. And there again, you'll see that our total provisions are split into two in terms of the specific provisions, again speaking to NPLs that have already gone bad, and then portfolio, which speaks to the provisions that we are making on the performing book. Now the provisions we're making on the performing book, that's the 634 million, and that's coming from a year ago where we were 356 million. So in terms of coverage ratio, that's gone from 1.2 to 2.1, that we have almost doubled the provisions that we are carrying on our performing book. What it means in terms of those movements in the income statement, again, you'll see there the split of the total, that we've charged 560 million on our income statement. And again, as I mentioned, split into two, close to 50-50. That's stage 3, the 283 million, up 120, and then stage 1 and stage 2, which is our performing book, and there we made a provision of 276 million. So almost the same as the stage 3 provisions. And that speaks then to the credit loss ratio of the 179 basis points, which is then made up 50-50 by the two. Half of it is being the performing book and the other half the non-performing. Now, we are in the reporting season. The rest of the market will be reporting numbers, and these numbers are not necessarily always comparable. Why would that be so? It comes back to, this number is based on our own house view in terms of our outlook on the repo rate, GDP, and then in terms of modeling thereof, there are probabilities that we assign to the core base, upside view and a stress view, and the weighted answer to that is what gives us our stage 1 and stage 2 provision. So in terms of comparing our number to the rest of the market, it's not always comparable, but the direction will be the same, or in terms of trends, but it's not entirely an exact science. And the other thing is, given the pandemic and models, all models have limitations, so that's why we speak of overlays and post-model adjustments, because again, as to the models were built for business as usual, and the times that we are definitely in is nothing but business unusual. And let me quickly zoom in again in terms of IFRS 9. IFRS 9 requires that we consider forward-looking information in terms of calculating expected credit losses. So again, we need to anticipate what are the losses that we see in the next 12 to 18 months, and that speaks then to the provision that we have made for stage 1 and stage 2. So it's not that the clients have gone bad, it's just an outlook in terms of what is the expected future credit losses to come through, and that's the additional 190 million that we put through to bring us to 276, which is almost us carrying an additional year of provision already in the current year. So in terms of what's the portfolio provision, it includes modeled numbers plus judgmental out-of-model adjustment taking into account forward-looking information. And in terms of additional provision, included in the 276 million is an extra 151 million that we took on top of what the models were indicating, which brought our total portfolio at 634 million on the balance sheet. So in terms of our view, we are of the view that we are adequately provided, carrying a total portfolio of 634 million, because a year ago we had a total charge of 215 million, and this is already at the peak of the recession in Namibia. So at 634 million versus 215, we are of the view we are adequately provided for the environment that we are in. But again, just in terms of highlighting, this number does include forward-looking information in terms of where we see the repo rate going, the GDP number, and inflation. So yes, it's modeled, plus then judgmental assumptions that go into this number. So in terms of the total charge to the income statement at 560, there's the 284 million, which is made up by non-performing loans, and then the portfolio provision of 276 million. Just to put it into context, yes, impairments are up, but one is already for non-performing, whereas the other half is for a performing book. If I can move over then to our non-interest income, again, this is one of those where the investment in the past is paying off, that by the time the pandemic hit and the lockdowns came through, our investment in our digital platforms were ready. So in terms of, again, volumes, we did continue to see good growth in our volumes. That despite the lockdown, our volumes year on year are up by 6%. And as you can see on the slides, our digital volumes are up by 14, and we do acknowledge that their revenue on the digital platform is lower than in branch, but still, again, our strategy came in handy by the time the pandemic hit. From a volumes perspective, the impact thereof, on the bottom part of the slides, you can see that the branch transactions are down by 20% comparing to the period before the lockdown, and you'll see that the ATMs as well, also down 9%. And in terms of dollar amount, the impact of the volumes and the relief we provided to clients, that cost the banking operation 70 million, and the other operations were also impacted by the COVID pandemic. In the Ashburton space, we see a loss of 35 million in their operations, and then from OUTsurance premiums and claims relief to our clients, that was a 3 million earnings loss that we saw. And also in terms of our rewards to clients, which is included in our NIR, that's up 16%, which amounted to 19 million for the year. But overall, our NIR is up year on year, just short of 5%, and our volumes are still up year on year. And again, in terms of what our reliance is in terms of volumes, our branches at this stage only make up 7% of volumes. But again, just a pleasing number to report that despite all the challenges that the market is facing, we are still seeing positive numbers from a revenue perspective. And in terms of, again, the split between our interest income and NIR, we still having that position of close to a balanced picture of 50-50 in terms of how much we make from NIR and the balance we make from interest income. If I can move over to our operating expenses, our efficiency ratio at 52.6, and that's also on a normalized basis, and our increase was at 2.6% when we look at it from a year on year. Looking at the pie in terms of the contribution of course, the largest part, which stands at 55%, that's made up by staff costs. The growth was 6.8%, and just to highlight the increase there, 6.8%, that's speaking of the increases a year ago, August, and that's the settlement with our union in terms of the non-managers. And the other challenge that we experience from a staff cost is then the growth in the leave days provision, whereas generally we would see utilization of leave days in the second half of the year, in terms of the school holidays in May or Easter or the Independence weekend, where people would take a couple of days in the second half. Given the restrictions on travel, we didn't see the utilization of days to what we had seen in the past. So the relief that we tend to see from a staff cost from leave days didn't come through in the current year. And the other adjustment to staff cost was then the bonus pool reduction by Ramco in line with the decline in profits. The other expenses, again, given the lockdown in terms of travel restriction locally and internationally, and the migration to electronic or digital meeting rooms, we saw a savings come through from travel, and the same with repairs and maintenance and other discretionary costs that we were able to contain. And our costs also include then our contribution to the Hope Fund, which was at 3.8 million. And given the environment that we're in, we had to assess our investment in Point Break, and that's where the goodwill impairment comes through. But this is an annual adjustment that accounting requires one to go through. If you're carrying a goodwill on your balance sheet, it goes through an annual assessment, and for the current year, we had to process an impairment there, and that's when I speak of normalized, that's the number we are normalizing for, and that's also the headline earnings adjustment. From the property cost perspective and depreciation, so that's also just a change in accounting with the introduction of IFRS 16. Rental expenses, a portion thereof ends up in depreciation, but the overall picture relatively stays the same. So there's a change in accounting standard. But otherwise, in terms of managing costs, in line with the migration of our clients to more digital channels, we are able to continuously reduce our branch sizes, and that was the same theme in the current year. As leases come up for renewal and branches come up for renovation, we reduce the branches in line with the volumes that we are seeing still utilization in branches. Now, looking forward, given that staff cost makes up 55% of our cost base, looking forward, we can already mention in terms of REMCO decisions already made, there's no increases for EXCO. Managers are getting below inflation increases, and then our non-managerial this time around are only getting inflation increases in terms of how we are managing our cost base going forward. That's just speaking to our 55, but there are continuous plans to continuously reduce our cost base and contain our cost-to-income ratio at that 52.6%. Moving on to our balance sheet, our total asset stand at 45.9 billion. We remain well capitalized from a Bank of Namibia CAR perspective at 17.6. So this is reflecting a typical banking operation. Our largest liabilities being deposits at 84% of our liabilities, and on the asset side, 65% is advances, followed by our investment securities. Our NAV is down year on year, and that was due to the special dividend that was paid early last year. And we are well capitalized, advances are well provided for, and we are carrying more liquid assets than required by the central bank. In terms of advances, credit extension at the end of the year was 2.5% in the market. Vehicle sales, no surprises there. It's been down almost for the past 5 years. But again, good growth. We are flat year on year because, as we've said before, we do not chase market share. We rather preserve our ROE of our business. From a franchise perspective or diversification of our book, our retail book was up 3%, RMB, Corporate and Investment Bank, just short of 4% growth. And then we saw a decline in commercial by 6. And in total, that gives us then the flat number for the year, and total advances at this stage at 31 billion. In terms of relief we've provided to our clients, that's total advances of 1.4 billion, and the cash flow relief to our clients would have amounted to 123 million. Otherwise, a good picture to see that credit extension is down, but we're able to keep our book flat for the year, and then also providing relief to our clients at this stage. In terms of deposits, this is also the other pleasing number to report. The deposit franchises that in a recessionary period were able to raise deposits that now stand at just short of 29 billion, a growth of 18.7%. And given the growth in the deposit franchises, we were able to reduce our expensive deposits down by 17% in the treasury space, which is now below the 10 billion mark. And in total, that's how we get to our 7% growth in deposits. That's the RMB and FNB raising deposits to the 18% growth, and then treasury down 16, which gives us the 7%. And then, of course, in terms of margins, with the rate cuts, we can't always pass on the full rate cuts to our clients, which puts then margin pressure on our business. In conclusion, we remain well capitalized at this stage. The final dividend for the year is 50 cents, which brings the total dividend for the year 854 cents. And in terms of capital, we solid capital position with a CAR of 17%. And when we do our forecast for the next 3 years, we still see our CAR in excess of 17%. We are adequately provided, provisions are in and overlays are in, and our capital is primarily made up by core equity. And in terms of financial resource management, that's a discipline that on a monthly basis we meet and debate. But again, just emphasizing that we are not chasing market share, but preserving ROEs. Thank you.
Oscar, thanks a lot for that presentation, and really a great set of results in the current circumstances. I think as Oscar showed there, the FRM discipline, financial resource management discipline that FirstRand applies is really something that has differentiated FirstRand over time and which has delivered market-leading returns while still maintaining a very robust balance sheet. I think also out of Oscar's presentation, it came clear that the benefit of having a portfolio of well-run and well-diversified businesses, all still within financial services, does give us the benefit to steer through the storm in a time when things are perhaps tougher in certain of those businesses than in others. I think the FirstRand model, a testing time like this, obviously is a good thing for us because it does show us where the weaknesses are within that model. And we've seen that within our model. The model is a proven model that's positioned to outperform in just about any environment. So even though FirstRand is not immune to the shocks that hits the economy, the shocks that hits the global economy at the moment on the outfall of the pandemic, it certainly shows that the business and balance sheet is robust to handle these shocks and to make sure that there's a sound and strong business that's there on the other side to help rebuild the economy in an inclusive growth story for the whole Namibia. I think also if we look at a story like today's and we look at the numbers that come through, these times are certainly unprecedented. And when you plan for the future and you do your stress testing, there's no textbook that gives us a reference point on how do you approach something like this. And I think there for us, it's a good point to just pause and reflect and thank Sarah for the leadership over the last couple of years. That's not only created the strong base for us to build from, but also as we came into the pandemic, drew on the strengths of the organization that we have, sitting in various pockets in various businesses that we have. Also the benefit of very strong discipline around cost management for the last few years is really coming through now and helping the business to be resilient in a time when there's a lot of pressure on the top line. We, throughout FirstRand, in all our franchises and businesses, these are all people's businesses and build on talent and men and women everywhere having to think hard about how do we solve for the problems of the day. And the investment in talent over the last couple of years is something that has been core to Sarel and his leadership team. And that benefit is certainly helping us to have many captains sailing our various businesses, big or small, through very stormy waters at the moment. The portfolio approach obviously is a great FirstRand attribute. And I think the unique structure of FirstRand, where we've got various portfolio businesses operating under different brands in different market segments, each with a very clear value proposition, a very clear market edge, and a very clear right to win, is something that in the current environment is proving to be a very successful model for us. Across these businesses, essentially, it's all FirstRand clients. And whether you are a money market client in Point Break or one of our asset management clients, or you're a retail client in one of our smallest branches or the biggest corporate, the client focus across the portfolio is getting a lot of attention. And the initiatives that we've put in place over the last few years is now nicely getting fast-tracked through not just our digital journey, but also the way we help clients to think about their own personal and business balance sheets. And I think that journey is something that's been coming and been a focus point for the last few years, which Sarel has been quite strong in pushing hard. And the benefits of that for our clients as they realign their own balance sheets well in advance of the pandemic not only allows the business to be stronger on the other side, but also our clients to be in a position where they can look to the future with a bit of hope as we all look to rebuilding this economy. Obviously, where we sit now, we've got no idea if we've really hit the bottom of the economic cycle on the outfall of the pandemic. We do think there's still some shocks coming, but we've learned a lot. And as we look towards the recovery of the economy, we look towards the recovery of our own business, the acceleration of many of our initiatives is taking up fantastic pace. And we think FirstRand will be there as a key partner for our clients. You know, one of the things we're driving hard at the moment is an enhanced, simpler user experience, just to make it easier to do business with us. A world of perhaps less forms, perhaps less administrative burden, both for the client and for our employees, and to make it faster and a nicer experience to just go about your day-to-day banking. Within our businesses across, I think we're really positive about the future and the growth story that FirstRand has. We've got really impressive management teams across the portfolio. The men and women that runs our businesses are deeply invested to make an absolute success of those businesses. They understand the client franchises really well. They understand their clients, understand what drives the economy, what drives national priority at a government level, down to a social need level, and able to combine those in a manner that meaningfully changes the societies in which we operate and meaningfully uplift the value that FirstRand can create for all its stakeholders. With that, then, we've also been on a journey to realign our business and the way we set up to move away from a product-structured organization to really being a client-structured organization and designed from the outside in. And I think that journey, our clients over the next year or two will find a very nice, streamlined approach, and that you don't have to knock on 4 doors anymore for 4 solutions. If you just think across the businesses that we have within the FirstRand Group, you know, the FNB Group has always had a very helpfulness in its approach, and the slogan speaks for it. Within RMB, the approach has really been to solve for the complexity and needs of the day. And our asset management business, Ashburton, have always said that we're going to give you access to alternatives that's not just run-of-the-mill out there in the market. And the way that you engage with that business is going to be an alternative manner as well. And I think where we are, and if we look towards the next few years, if one can partner with an organization that's helpful with a solutionist mindset and willing to look at alternative ways, it's really a combination that can be a very nice partner as one takes on this next journey in Namibia. Our enterprise development is something that, if we look towards the next chapter in the country, you know, if we're going to recover this economy, enterprise development is going to be absolutely key. And that is rebuilding small businesses, helping our big businesses carry through, and thinking with medium-sized businesses about how do they tackle the future, where do they invest, and where do they recapitalize. You would have noticed in recent media releases the collaboration between FNB and the Development Bank on providing easier access financing for SMEs. And I think there's more coming in that space. It's something we're passionate about. We understand structurally how the economy is changing, which sectors in the economy is informalizing, and which sectors are those that's meaningfully not only going to create economic growth, but also meaningfully create jobs, meaningfully create forex earnings for the economy, and the enabling role that we can play in building that out in a mutually beneficial way for the FirstRand Group, for our clients and the societies in which our clients are operating. And I think if we then sort of say, you know, there's often talk about where do banks and financial services businesses sit in this time. if we look across the board and beyond the FirstRand Group, if we look at financial services in Namibia, I think the sector has proven to be resilient. The lessons learned from the last financial crisis, the way we think about capitalization, and the prudence that's applied across the industry has really meant that Namibia has a sector that is well positioned to steer through this, not without pain. Obviously, there's substantial implications for our shareholders, for our employees, for other stakeholders, but the pain taken within these industries is not at such a level that we don't have industries that can resiliently and robustly rebuild the economy on the other side. There's already some green shoots as we see our own clients starting to invest in the economy again, and we see a bit of positiveness coming through, and it could be that spring is in the air, and spring always brings that positiveness. But I think Namibians has proven to be a resilient people, and we've been through many shocks over the years. If you take our own business, we're 113 years old now. And a business like that, if you talk to other businesses that's been here for 100 years plus, all these businesses have been through 2 world wars, they've been through the Great Depression, they've been through a border war in our own country. We've been through tumultuous changes in the country. And these businesses have all steered through. These businesses have all continued to invest and have all come to an understanding that long-term sustainable permanent capital creation is not a 6-month or a 1-year story. It's a generational story. And FirstRand understands and invests in a generational scope as we look to the future. And then looking to that future, changes is almost as normal as anything else in the organization. But within that, our principles on which the organization is built remains unwavering. We've got what I like to call a Brandberg type solid balance sheet on which we built the organization. Our risk, governance and conduct principles remains unaffected irrespective of the cycle. These are the true North principles on which FirstRand continues to build a solid organization. Our operational reliability is extremely important for us. The fact that our clients can rely on us, that our regulator and our role within bigger compliance within the country and risk management, that we are a reliable, trusted partner, and that is important for us. And then we continue to invest in the future. And we'll continue to invest in our customer experience. We'll continue to invest in making our organization simpler. We continue to invest in our platform journey. And it's a really exciting journey, both for our customers and for those who work for us. And obviously an investment like that is only done and possible with a very high level of cost discipline. We need to spend smart. We can't save ourselves to greatness. And we need to make sure that we still have the absolute best talent in order to activate, drive and deliver on this journey and promise that we have to our employees, our stakeholders, our shareholders, and particularly importantly, our customers. I think also then if we look forward, and perhaps a good underpin for our business is really an integrated approach on a business that delivers on our environmental promises, something that's very dear and near to the entire executive team is our natural legacy that we have in Namibia, and how do we play a meaningful role to protect and grow that. And the role that tourism has as probably one of our most sustainable sectors in the country in future. Understanding the importance of our other sectors to have sustainable social impact, sustainable benefit to government, sustainable benefit to our employees. And then to build all of these into our business and our operating decisions on a day-to-day basis. And to really make sure that the value that we create is value that's shared very wide throughout our our customer base, value that's shared wide within society in Namibia, and that's shared widely for all of those that rely on us, the friends, families, and investors of the First Rank Group. I'd like to thank you for your time today. It's been a great morning, and we really look forward to the engagement over the next year as we share more of this journey and as we look forward to build a really exciting next chapter for the First Rank Group in Namibia. Thank you.